Picture a woman at a bank counter, holding a folder against her chest, like it's the last thing she owns. Across the desk, a friendly employee slides a form toward her and taps one empty box: annual income. She doesn't fill it in. She just looks up and asks the one question almost nobody at that counter ever asks. Why do you actually need that? It's a completely fair question, and we almost never ask it. We hand over our income on loan applications, on pop-ups that promise to serve us better, on little forms that feel about as serious as typing in a phone number. Here's what we miss. That number doesn't just land in a file and go to sleep. The second it enters their system, it starts working, quietly, constantly, and not really for you. So today, let's do something simple. Let's follow your income on the exact path it travels the moment you say it out loud, from the counter into the software, and out the other side as the limit you're offered, the rate you're charged, and the products you'll spend the next decade getting pitched. By the end, you'll know precisely when handing that number over helps you, and when you should keep the folder pressed right where it is. But this story doesn't begin at the counter. It begins with a question most of us never think to ask. Is the bank even allowed to require your income? Or have they just gotten very good at making a request feel like a rule? The honest answer surprised me, and it's more interesting than the version you usually hear. For a credit card, there genuinely is a law in play. After the financial crisis, Congress passed the Credit Card Act of 2009, and the rule that came out of it, Regulation Z, Section 1026.51, says a card issuer can't open an account or raise your limit without first considering whether you can actually make the payments. That's the famous ability to pay rule. So when a credit card application asks about income, it isn't pure nosiness. There's a real legal box they're checking. Now here's the part the bank would rather you glossed over. The same rule lets issuers consider your income using, and I'm quoting the regulation's own language, an empirically derived, demonstrably and statistically sound model that reasonably estimates a consumer's income or assets. Translate that out of lawyer, and it means this: they're allowed to guess. They can model your likely income from data they already hold, which means in plenty of cases, they don't strictly need you to type the number at all. They ask anyway because a number you volunteer is cleaner, cheaper, and far more useful to them than one they had to estimate. And that's only credit cards. Walk over to the other side of the bank, the checking and savings side, and the legal picture changes completely. To open a basic deposit account, federal identity rules require 4 things from you: your name, your date of birth, a physical address, and your social security number or taxpayer ID. Income is not on that list. So when you're opening a simple checking account and a field appears asking what you earn, that field is almost always optional, dressed up to look mandatory. Think about that for a second. The places we're most trained to surrender our income, the routine update your info prompts, the deposit account forms, the cheerful little surveys, are frequently the exact places where the law doesn't require it. Take Marcus, opening a simple checking account at a branch downtown so his paycheck has somewhere to land. The teller's tablet asks his annual income, and Marcus, like all of us, starts to type. Nothing on that screen tells him the truth, which is that the law opening this account only needs to know who he is, not what he makes. Now move Marcus across the lobby to the desk where he applies for the bank's rewards card. Same person, same building, same gray afternoon, but a completely different legal reality. Here, his income actually matters to the decision, because the issuer is required to weigh whether he can handle the payments. 2 requests for the very same number, 10 feet apart, and only one of them has any teeth behind it. The bank is quietly counting on Marcus never noticing the difference, and most of the time, he doesn't. And those update your income pop-ups deserve a closer look, because there's a specific reason they exist. Under the same ability to pay rule, a card issuer has to refresh your income before it raises your credit limit. It can't lean on a stale number from years ago. So that friendly prompt asking you to confirm your current salary, the one framed as housekeeping, it's frequently the trigger that lets them justify handing you a bigger limit. You think you're tidying up your profile. You're actually arming a credit line increase you never asked for. The pop-up seemed like admin. It wasn't. It's worth pausing on how handing over this number ever became so automatic in the first place. A generation ago, your salary was something you discussed with your spouse, maybe your boss, and almost nobody else. Then lending went digital. Data turned into the most valuable thing a company could hold, and every form quietly grew an income field. Repetition handled the rest. Ask people for the same thing on enough screens, in a calm enough tone, and they stop registering it as a question at all. It starts to feel like punctuation, just one more blank to fill on the way to whatever you actually came for. That little flush of obligation you feel when the cursor blinks in the income box wasn't born in you. It was trained into you, one routine form at a time, by an industry that profits most when you answer without pausing. The bank deliberately blurs the line between required and requested because a customer who knows the difference behaves differently, and a customer who behaves differently is less profitable. That blur is the whole game. So let's stop arguing about whether you have to give the number and start following what actually happens when you do. The first thing the machine does with your income is size you up. The instant your salary enters the system, an algorithm runs it through a calculation lenders live and breathe by, called debt to income, or DTI. It takes your monthly debt payments and divides them by your monthly income. Lenders treat anything under 36% as comfortable. Once you push past 43%, approvals get harder and the terms get worse. Your income is the denominator in that fraction, which means the number you state directly sets how much more debt they're willing to pour on top of you. On paper, this looks protective. They're checking you can afford it, right? Sometimes. But watch how it actually plays out, because the incentive runs sideways to yours. A bank makes its money when you borrow and carry a balance, not when you're careful with your cash. So a higher stated income doesn't just unlock approval, it unlocks a bigger credit limit, a premium card tier, sometimes a slightly better headline rate to lure you in. And a bigger limit is not a trophy, it's more rope. Picture two people walking into the same branch on the same gray afternoon. The first mentions a salary of $50,000 and gets offered a limit of $4,000. The second mentions $140,000 and walks out with a limit of $25,000, plus an invitation to a fancier card with a metal finish. The bank will frame all of that as respect. Look how much we trust you. What they won't say out loud is that decades of their own data show people with higher limits tend to carry higher balances. The room to spend slowly becomes the spending. The person holding $25,000 of available credit isn't more secure than the one holding $4,000. They're standing closer to a longer cliff with a much faster running start. And the timing of all this matters more than it ever has. As of the fourth quarter of 2025, Americans were carrying about $1.28 trillion in credit card debt, according to the New York Federal Reserve, up roughly 5.5% from the year before. Total household debt across mortgages, autos, student loans, and cards had climbed to around $18.8 trillion. And nearly 5% of all of it was sitting in some stage of delinquency, with roughly 140,000 people a quarter picking up a fresh bankruptcy mark on their credit reports. We are not, as a country, suffering from a shortage of available credit. We are drowning in it. The income number you volunteer is one of the small levers that decides how deep your particular pool gets. So the first thing they do with your income is decide how much you can owe them. The second thing is decide how much they get to charge you for the privilege. And this is the part that flips the whole picture upside down. Most of us assume the logic is simple. Higher income, lower risk, lower interest rate. A reward for being responsible. The reality is colder, and honestly, a lot more clever. Your income tells a lender two completely separate things. The first is how likely you are to repay, which is the risk story we all understand. The second is something far more valuable to them, and it almost never gets mentioned at the counter. Your income hints at how much you'll quietly tolerate. It's a clue to your price sensitivity. Someone on a tight budget notices every percentage point and every fee, because they have to. Someone comfortable, with money landing steadily every couple of weeks, often doesn't bother to check the rate, doesn't shop around, and won't switch providers over what feels like loose change. The software has learned this pattern across millions of accounts, and it prices you accordingly. There's a polite name for this inside lending circles: ability to pay pricing. The more a system believes you can absorb, the more it quietly assumes you'll accept. Not because you've become a bigger risk, but because you've become less likely to walk away. That average credit card interest rate, hovering around 21% in early 2026 per the Federal Reserve, that's just an average. The rate that actually lands on your account is a personalized decision, and your income is one of the ingredients folded in. And the pricing doesn't stop at the headline number. Step one foot out of line, and you discover the tiers underneath. Miss a payment, and a penalty rate near 27% can kick in. Pull cash from the card, and you're looking at something around 24% that starts charging interest the very same day, with no grace period at all. These aren't accidents. They're carefully designed floors and trapdoors, and the more the system believes you can pay, the more comfortable it is letting you wander toward them. And it's worth slowing down to see what that pricing actually costs a real person, because the headline percentage hides most of the damage. Say you're carrying a balance of $5,000 on a card, sitting at that average rate of about 21%, and you do exactly what the bank quietly hopes you'll do, which is pay only the minimum each month. That minimum is engineered to cover barely more than the interest itself, so the balance crawls downward by inches while fresh interest keeps stacking on top. And what looks like a manageable $5,000 can stretch into well over a decade of payments and cost you thousands of dollars beyond what you originally spent. Here's where it loops back to your income. The number you stated set the limit. The limit set the room. The room invited the balance. And the balance, at that rate, paying minimums, is precisely where the bank earns its living. Your salary didn't just help you qualify, it quietly helped shape the most profitable version of you, the one who borrows comfortably and repays slowly. From your side of the desk, that feels like a mistake you made. From their side, it's the system performing exactly as built. If you're wondering how all of this is even legal, so is everyone else. And it's not a fringe theory anymore. In July of 2024, the Federal Trade Commission sent formal orders to 8 companies, including JP Chase and MasterCard, demanding details on how they use personal data to set prices for individuals. In January of 2025, the agency released its early findings, and its own staff described a quiet market where everything from your location to your browsing to your purchase history to your demographics can be poured into systems that tailor the price you, specifically, are shown. They gave it a blunt name: surveillance pricing. New York then passed a law requiring businesses to disclose when a price was set by an algorithm using your data, with wording that has to tell you, plainly, that the figure in front of you was generated from your personal information. And in December of 2025, regulators opened an investigation into one grocery delivery platform's pricing tool specifically. That's the public side of the story. Behind the scenes, the same instinct that lets a website nudge a price upward for a shopper it has profiled is the instinct a lender brings to your income. The number isn't only a measure of whether you can pay. It is increasingly a measure of how much you'll let them take before you notice and complain. So yeah, not quite the warm partnership the brochure promised. There's one more piece of this most people throw straight in the recycling. When a lender gives you worse terms because of what's in your credit file, federal law often requires them to send you a notice about it, a risk-based pricing notice. It's that dull slip of paper explaining you didn't get their best rate. Almost nobody reads it, but it's a paper trail telling you, in writing, that you were sorted, scored, and priced. That slip looked like junk. It wasn't. And none of these rates are carved in stone, which is the part the bank is least eager to advertise. The number on your statement is a setting, not a law of nature. It was chosen by a model, partly on the basis of what your income suggested you'd quietly accept. Settings can be changed. A figure dialed in when you were a brand new, unknown customer can be dialed back down once you've proven yourself, though almost never on its own, and almost never because the bank woke up feeling generous. It moves when you make it move. Hold on to that thought, because it matters more by the end of this than almost anything else we've covered. Let me give you a beat to sit with that, because it changes how the next part lands. Then it gets even more personal. If you've been finding this useful, go ahead and subscribe. This channel breaks down how the money system actually works, in plain language, every single week. Now, back to your number, because while you've been focused on the form in front of you, Something much larger has been happening with the digits you already gave away. The third thing the machine does with your income is turn you into a target. The moment your earnings are categorized, you quietly stop being a customer and start being a market segment. And then the offers begin. You know exactly the ones I mean. The premium card with the heavy annual fee that suddenly shows up in your inbox. The pre-approved personal loan you never requested. The line increase invitation that lands right as your balance starts creeping up. None of that timing is luck. It's calibrated to the income bracket your own number placed you in. A lot of that targeting runs through something most people have never heard of, called pre-screening. Under the Fair Credit Reporting Act, lenders are allowed to pull a slice of your credit profile to decide who gets a firm offer of credit without you ever applying for anything. That's why the pre-approved envelopes arrive before you've lifted a finger. Your income and your credit behavior already nominated you. And high earners get a very particular menu. Aggressive pitches for fee-heavy premium cards, because the data says someone earning $180,000 is far likelier to shrug at a steep annual fee than someone earning $60,000. And those fees are not small. Plenty of premium cards now run a couple $100s a year, and the flashiest ones climb toward $900 annually. Sold to you with a smile because your income said you'd say yes. That's the story for the comfortable. Lower income customers get sorted into a different line, and it's worse. Fewer premium offers, more of the predatory kind. Balance transfer deals with fees tucked into the fine print. Loans at punishing rates. Limit increases engineered, almost surgically, to encourage exactly the overspending that spins off interest. The targeting is precise because the data is precise, and your income is what sharpened it. Put two real lives next to that sorting machine. Dana clears a comfortable salary, and her mailbox fills with thick envelopes for travel cards and premium perks, each one quietly betting she won't blink at the fee. Renee earns far less, works every bit as hard, and her mailbox fills with an entirely different stack. Quick cash offers, high-rate loans, and limit bumps that seem to arrive right when money is tightest. Neither woman applied for any of it. Neither one knows that her income is the thing dealing the cards. They just notice, vaguely, that the offers seem to know something about them. Because they do. The system isn't singling either of them out of malice. It's optimizing, coldly and at enormous scale, for the most profitable move on each. And the input that makes that optimization possible is the same number we keep treating as harmless small talk. Here's the detail that explains everything. You can actually opt out of a big chunk of this. The credit bureaus are required to run one official channel where you remove yourself from pre-screened offers at a site spelled optoutprescreen.com or through a toll-free opt-out line the bureaus must keep open. One short request can quiet the fire hose for years. The banks would simply prefer you never found out it exists. And the sharing goes deeper than marketing envelopes. Under a federal privacy law known as Graham-Leach-Bliley, every bank has to hand you a privacy notice, that dense little pamphlet you've tossed 100 times. Buried inside it is a genuine right. You can tell them to stop sharing certain personal information with unrelated outside companies. Most people never open it, never use it, and so the default quietly holds. And the default is sharing. Now, here's the catch worth knowing. That opt-out usually covers companies outside the bank's own family. Sharing among a bank's own affiliates, all the cousins under one corporate umbrella, is looser and harder to shut off. So your income can travel surprisingly far without ever technically leaving the building. That pamphlet seemed like spam. It wasn't. And the reason they want it traveling at all comes down to a phrase you'll hear inside any bank: share of wallet. To them, you are not one product. You are a potential stack of them. A checking account today, a credit card next quarter, an auto loan, a mortgage, an investment account, maybe an insurance policy. Each one another stream of fees or interest. Your income is the map they use to decide which products to chase and in what order. A higher number doesn't only mean a bigger limit, it moves you up a ladder of relationship tiers, where the offers get glossier, the calls get more frequent, and the goal, stated plainly in their own strategy decks, is to deepen the relationship until you've handed them as much of your financial life as they can hold. So the friendly banker asking warm questions about your goals isn't only being kind, they're mapping the wallet. Understanding that doesn't mean you slam the door on every product they mention. It means you remember whose interests are quietly steering the conversation the moment one gets offered. By now, you might be feeling like the smart move is just to clam up everywhere, reveal nothing, starve the machine. It's a reasonable instinct, but there's a twist waiting, and it's the one that should change how you think about this entire game. Because here's the genuinely uncomfortable truth. In a great many cases, the bank already knows your income. You telling them is mostly a formality. Sitting quietly inside Equifax, one of the 3 big credit bureaus, is a database called the Work Number. Most Americans have never heard the name, and that is exactly how it has run for decades. By Equifax's own published figures, it holds more than 823 million employee records, fed by more than 5 million employers who send in payroll data, often every single pay cycle. Your salary, your job title, how long you've been there, your pay, period after period, stacking up into a history that can reach back years. It doesn't just hold your current job, it behaves like a permanent archive. Take a moment with those numbers, because they're the kind that should stop you cold. That is not a sample. That is most of the working country, with the details refreshed roughly as often as you get paid. When a mortgage lender, an auto dealer, a landlord, or a government benefits office needs to confirm what you earn, more and more of them don't call your boss anymore. They query the work number and get an answer in seconds. And under federal rules, that data can flow to anyone with what the law calls a permissible purpose, which very much includes lenders sizing you up before they ever speak to you. So when that checking account form asks for your income, part of what's happening is theater. They are inviting you to confirm, in your own handwriting, a number a back channel may already hold. The figure you provide becomes one more data point layered onto a profile you can't see and never built. That little box felt like a small, harmless request. It never was, because it was never the only door your income walks through. The other door was open the whole time, and you didn't put it there. Your employer did. There is something you can do about the work number, and almost nobody does it because almost nobody knows it's there. You can request your own employment data report, see exactly what they've got on you, and place a freeze on it so it can't be handed out without your permission. It's the same idea as freezing your credit, a simple lock on a door you didn't realize was standing open. And given that Equifax is the same company that suffered one of the largest data breaches in history, knowing where your salary history lives and being able to lock it is not paranoia, it's basic hygiene. And the work number is only the back channel that happens to have a name. There's a quieter one most people walk right past every day, and it's your own account. If your paycheck is direct deposited where you bank, then your bank doesn't need to ask your income at all, because it simply watches the money arrive. Every 2 weeks, like clockwork, a deposit from your employer lands, and that rhythm tells them what you earn with more accuracy than any form you'd ever fill out by hand. They can spot the raise before your relatives hear about it. They can see the bonus, the side gig, the month things suddenly got tight. So while you're carefully deciding whether to type a number into a little box, the institution holding your checking account already has the answer sitting in your own transaction history. The box was never really about discovering your income. It was about getting you to confirm it, on the record, in a form they're free to act on. It goes a step further now, too. More and more applications, instead of asking you to type a salary, ask you to connect your payroll or link your bank account, usually through a third-party tool that slides quietly between you and the lender. One tap, and you've handed over a live window into your deposits, your balances, and your income, refreshed automatically without you lifting a finger again. It feels like convenience, and honestly, part of it is. It also gives away far more than the single number the old paper form ever wanted. That cheerful connect button is doing the work of 100 income boxes at once, and most people press it without a second thought because it's faster. Faster for you, and far more revealing for them. While we're talking about doors, Here's where 2026 gets genuinely murky. There was supposed to be a rule, finalized back in October of 2024, called Section 1033, built on a simple, almost obvious idea. Your financial data should belong to you, and you should be able to access it, move it, and control it for free. As of right now, that rule is tangled in court and under reconsideration, its future unsettled. The compliance date's a moving target that keeps sliding. Sit with the irony of that for a second. The information about your money gets bought, sold, modeled, and traded across a sprawling private market every day of the week. Your own plain right to control that same information is the part still stuck in limbo. Funny how the thing that helps them moves fast, and the thing that helps you moves not at all. There's one more quality of your income data almost nobody thinks about until it bites them. It doesn't expire. The number you handed a lender 3 jobs ago doesn't politely delete itself the moment your life changes. It lingers in archives, in models, in that payroll database that behaves like a permanent record. So the income you reported when you were thriving can quietly anchor how a system sees you years later, after your situation has shifted underneath you. And the reverse stings just as much. A lean year, a gap between jobs, a stretch of lower earnings, all of it hangs around in the data long after you've recovered, ready to resurface inside a decision you didn't even know was being made about you. We tend to picture our income as a present tense fact, just what we make right now. The machine treats it as a timeline, a long tail of every number we've ever attached to our name. That's a big part of why being deliberate matters. You're not only deciding what one form sees today, you're deciding what gets written into a record that may well outlast the job, the account, and the version of you who first typed it in. So let's pull this all the way back to the woman at the counter, holding her folder, asking why. Because now we can finally answer her. And the answer isn't reveal nothing, and it isn't blindly trust them. It's something far more useful. It's know which number does what. Here's where it gets practical and where you take the control back. Start with the moments where giving an accurate income genuinely works in your favor. When you're applying for a credit card, the law already requires them to weigh your ability to pay. So a truthful, complete income, including the money the rules actually let you count, like funds you have reasonable access to, can mean a fair approval and a sensible limit instead of a lowball or a flat decline. When you're getting a mortgage or an auto loan, your income is going to be verified through pay stubs or that very work number database, no matter what you write. So there is nothing to gain by being cagey and quite a lot to lose by being inconsistent. In those rooms, accuracy is your ally, and a clean, confident number is the smart play. Now the moments to keep that folder closed. The update your income pop-up on an account you've held for years, the one that quietly tees up a credit line increase. The income field on a basic checking or savings application, where the law only needs your identity. The casual survey, the loyalty form, the cheerful request to help us serve you better. None of those are legal requirements, and every one of them is a fresh opening for your number to be repackaged into limits, pricing, and pitches built around their margin, not your goals. When something is requested rather than required, you have a choice. The entire trick the bank relies on is that you forget you have it. Use it. And using it can be as simple as one calm question, asked out loud, the same way the woman at the counter asked hers. Is this required or is it optional? Notice how often the honest answer is optional. And notice how rarely anyone offers that word unless you pull it out of them. If they tell you it's required, you're allowed to follow up. Required by what exactly? A law or your internal policy? For a deposit account, the law's answer is your identity, not your earnings. For a credit card, fair enough. The number genuinely belongs there. So hand it over accurately and completely. You're not being a difficult customer by asking. You're doing the single thing the whole system is quietly built around you not doing, which is treating your own information as something with real value, to be spent on purpose, rather than sprinkled onto every form that asks you nicely. Then go close the back doors while you're at it. Pull your work number employment report, check it for errors since plenty contain them, and freeze it if you don't have an active loan in progress that needs it. Make that one opt-out request to step out of the pre-screened offer stream so the targeted envelopes lose your address. The next time a privacy notice lands in your mailbox, actually open it, find the sharing section, and tell them no. And when a worse than expected rate shows up with a little notice attached, read the notice instead of binning it because it's telling you how you were scored. None of this is glamorous. It's maybe 20 minutes of unglamorous admin spread across a month, but it quietly unplugs you from several of the exact systems we just followed your income through. And there's one more move that turns the whole willingness to pay game back around on the bank, and it costs you a single phone call. Remember, the model quietly bets you won't bother to push back on your rate. So become the customer it didn't price for. Call the number on the back of your card, mention that you've been a reliable payer, and ask, plainly, for a lower interest rate. It works far more often than people expect because the bank would much rather shave a few points than lose an account it's still earning from. The same logic stretches across fees. A late fee waived, an annual fee reconsidered, a retention offer you only ever hear about because you asked for one. None of this takes leverage you don't already have. It takes doing the one thing the model assumed you were too comfortable, too busy, or too intimidated to do. The willingness to pay machine only runs smoothly while you stay quiet. The moment you speak up, you stop being the easy, profitable customer it sorted you into, and you turn into the one it actually has to compete for. While you're at it, get in the habit of pulling your own credit reports, which you're entitled to check for free, so you can see roughly what the lenders see when they size you up. You can't manage a profile you've never looked at, and most people have genuinely never read theirs. Spotting an error there, an account that isn't yours, a balance reported wrong, a stale figure dragging you down, can do more for your terms than any negotiation because it fixes the raw material the whole machine runs on. Think of it as reading your own file before they do. The institutions have been studying your numbers for years. It's only fair that you finally study them back. None of this is about hiding from your bank or treating money like something shameful. It's about understanding one thing clearly. Your income is data. Data is leverage. And right now, most of that leverage is pointed at you instead of held by you. The woman clutching the folder wasn't being difficult, and she wasn't being paranoid. She was being literate. She understood, before she filled in a single box, that the most valuable thing on that entire form was the one number they were working hardest to make feel routine. So picture her one last time. The same counter, the folder still against her chest, the employee tapping that empty box marked annual income. Except now you're standing in her shoes, and you finally know what that box is really for. You know it might feed a limit that's more rope than reward, a rate quietly tuned to how little you'll complain, an offers machine that sorts you by bracket and sells you accordingly, a hidden database that very likely holds the answer already. And knowing all of that, you also know which version of yourself to be in that moment. Not the one who fills it in on autopilot, and not the one who panics and trusts no one. The one who asks, calmly and out loud, the exact question she did. Why do you actually need that? And then decides, on purpose, whether to answer. Everything we just walked through, the limits, the pricing, the targeting, the hidden databases, it all quietly rewards the same single thing, knowing how the system works before you step inside it. That, far more than any one clever opt-out, is what separates people who feel cornered by money from people who feel calm around it. If this opened your eyes even a little, then the real starting point was never a single trick at a single counter. It's the foundation sitting underneath every one of these decisions, the plain financial literacy that lets you see the whole machine clearly the first time, instead of learning it the hard way after a number's already been turned against you. That groundwork is where any solid money journey actually begins, and it's the thing I'd want you to have firmly in place before anything else, because it makes every choice after it easier. There's a video on this channel built to do exactly that, to hand you that footing so the rest of these decisions stop feeling like guesswork and start feeling like yours. It's the natural next step from here. And honestly, if you're just starting to take this seriously, it's the one I'd begin with.